Hi, I'd like to welcome clients, old and new alike, to our third investment committee update call of 2020. For those of you who don't recognize my voice, I'm Matt Kane, a partner and president here at the firm. I'm joined by two of our investment committee members and two of my favorite people on the planet, Jim Baird and Josh Manifold, both of whom work with George Limbach and me day to day, and like many of you, may be suffering from some sort of acute video conferencing fatigue. Thanks for taking the time out of your busy, albeit socially distanced schedules to be with us here. Whether it be live here on a Thursday afternoon or on a recording we'll be passing around in the days to come. We'll take the next 20 minutes or so to address what we're working through as a team. Jim will handle the economic and market forces at work, and then Josh will detail some of the action we're taking as a result in an encouragement to continue to think about your financial plan within the context of all that's going on. With that, let me turn things over to Jim, who's the founding member of our firm. Jim, take it away.
Thanks, Matt. Since it's been about 4 months, I thought it would be helpful to start out by giving a short recap of what the environment was like during the time of our last call at the end of March. On the negative side of the ledger, the S&P 500 had declined by 34% in just over a month's time frame, one of the largest short-term meltdowns in the history of the market. Almost all asset prices other than government bonds were in the process of collapsing. The rapidity and magnitude of the market drop was almost unprecedented. On the coronavirus front, cases in China had diminished substantially, but they were still spiking in Europe. In the US, reported new infections were earlier on in the process of skyrocketing, but looming ominously nonetheless. Uncertainty and extreme fear permeated the world as there seemed to be few answers about how to effectively treat those who were sick, yet alone contain the spread of this pandemic. The mortality rate of the virus was frighteningly high. On the positive side of the ledger, at the time of our last call, the Federal Reserve responded rapidly by implementing both previously used as well as a series of new programs. These were designed to restore liquidity to the financial system as well as to extend credit across the full spectrum of borrowers. The magnitude of these measures that they implemented dwarfed what they'd done during the great financial crisis about 11 years ago. Congress was in the process of passing the $2 trillion CARES Act, which would send stimulus checks to millions, dramatically increase unemployment benefits, create a number of programs to support businesses, healthcare providers, and also to inject liquidity into state and local governments. If there was one word to summarize the environment at that time, it would be uncertainty. And more than anything, this is the one factor to which the financial markets have their biggest aversion. The fact that the volatility index hit a record high about a week before the last call attests to the fear that permeated the markets at that time. What has happened to the economy and the markets and the healthcare picture since then? Well, regarding the economy, in March and April, things collapsed to a depression-like environment as governments around the world instituted various lockdown measures to try to flatten the curve and lessen the severity of the pandemic. The US unemployment rate went from 3.5% in February to 14.7% in April. The increase in initial filings for weekly unemployment went from about 2 to 250,000 people to almost 7 million. As a result, consumer spending plummeted 19% cumulatively in March and April. Remembering that more than any other metric, consumer spending has the greatest bearing on our economy, as it accounts for about 2/3 of our GDP. In addition to unemployment and consumer spending, most other measures of economic activity, both in the US and globally, collapsed to levels that resembled a depression. Then the world began the process of slowly starting to reopen. Consumer spending rebounded sharply by over 8% in May. After peaking at close to 25 million people, continuing claims for unemployment dropped by over 1/3 during the next 2 months. Retail sales, manufacturing, consumer confidence, and most other economic metrics recovered substantially as well, but to levels that were still significantly below where they were prior to the outbreak of the pandemic. The strong initial surge in activity could be attributed to pent-up demand coming out of the lockdown phase, as well as the impact of the various government programs. So where are we now? Over the last few weeks, the economy has been showing signs of slowing down. To some extent, this is to be expected as the initial surge from the pent-up demand during the lockdown phase has run its course. Additionally, there's some significant governmental benefits that are due to expire shortly if Congress does not choose to extend them. This is causing both companies and individuals to behave more cautiously. But probably the biggest causes are the recent spikes we've seen in new infection rates that are exploding in states like California, Florida, Texas, Arizona, and a number of others. Regarding the markets, throughout this period, the S&P 500 has been very strong, recovering all but about 4% of the sell-off that took place from February through March. The enormous amount of liquidity that's been injected into the global economies by both governments and central banks has been a major source of support to markets, despite a very damaged and uncertain economic environment. The markets seem to be focusing on the potential for a significantly improved outlook extremely far into the future. To illustrate this, let's look at some projections for corporate profits. While earnings projections for this year and next have stabilized lately, the graph we're showing now depicts how much profitability forecasts have declined over the past few months. The top graph represents 2021 earnings estimates. The bottom graph represents profitability estimates for 2020. The next graph we're showing depicts that 2021 earnings estimates are almost identical to what were attained last year. The S&P 500 is higher now than at year end, despite estimates for a 20% drop in earnings this year. And even 2021 earnings are only expected to match last year, with these projections being made during a time of historical uncertainty. So even accounting for lower interest rates that we're seeing now compared to year end, this seems to be a much higher risk environment for equity exposure. Beyond the elevated price to pay for stocks right now, the market recovery since March has not been broad-based. The S&P 500 has become dominated by a number of very large technology companies that benefit from the stay-at-home work environment. To illustrate this point, the 5 largest companies in the S&P 500, or only 1% of the stocks in the index, account for over 20% of its performance. These 5 stocks are Amazon, Apple, Facebook, Microsoft, and Google. Year to date, their average return was about 34%. Meanwhile, the average performance of the other 495 stocks in the index was a decline of about 8%. One last example of how historically narrow market returns have been. Let's look at returns from growth stocks, such as technology and communication companies, versus value stocks like energy, utility, and manufacturing companies. This chart from July 2nd illustrates the largest gap that we've seen in growth versus value returns since the dot-com bubble, with value stocks having average returns of about an 18.5% decline, while growth stocks have been up almost 15% on average. Regarding the healthcare picture, the lockdowns seem to have helped, In the US, new cases rose sharply until the latter part of April, but then declined steadily until mid-June. Reopening has brought a setback as daily infections have more than doubled since then and are about twice their peak from April. The US has had the highest number of cases in the world, almost twice that of Brazil, even though our population is only 50% greater. Now, on the positive side, there has been marked progress with the production of a vaccine, and the mortality rate is diminished as healthcare professionals are more knowledgeable and better equipped to handle the virus now than when it first broke out. Where do we go from here? This is clearly a time that is unprecedented in the history of the global economy and stock markets. Uncertainty and fear remain elevated, with the volatility index still almost twice as high as it was pre-COVID. Here are just a few of the questions with which investors are wrestling currently. Near term, will Congress pass another round of stimulus legislation? What will be the impact of the recent resurgence in new infections? When and to what degree will there be a second wave? When will an effective vaccine be widely available, and how quickly will its use be adopted? How severe will bankruptcies, mortgage defaults, foreclosures, and future layoffs be? And lest we forget, there are some issues on the non-COVID front too. One of which is, what is the impact of the November elections going to be on taxes, regulation, and other issues on which the markets focus? A second big one is, what will become of US-China relations and the future for trade policy? So in light of all this, what have we been doing with your portfolio? At Compass Ion Advisors, our first objective is to help you achieve the goals you have set out in your financial plan. Accordingly, we focus on minimizing major losses and other big sources of risk to your plan. We did this by trimming exposure to equities during the period of the meltdown, at the height of the unprecedented uncertainties that we were facing at the time. We have reinvested some of these proceeds as the environment has gradually improved, but we're still about 10% underweight our normal exposure to equities. While this has not been a profitable near-term decision, we're not convinced that we're out of the woods yet. Over my 40 years in the business, you'll learn that markets humble the most successful investors from time to time. And this environment has certainly shown us our own fallibility as we try to responsibly steward your assets. For more specifics on our investment decisions and outlook, I'll turn this over to Josh Manifold, the partner at our firm who oversees our investment committee.
Thanks, Jim. Our investment committee has been very busy. We take our responsibility very seriously. We continue to exercise intellectual humility as we process a significant amount of data in these historic times. Every model allocation has two buckets that make up a diversified allocation. We know our primary role is risk management. The first bucket is called the strategic bucket. It's the largest bucket. Its mandate is identifying investment opportunities with a 3 to 5+ year timeline. It's made up of global stocks as benchmarked to the ACWI or the global stocks. The goal here is to outpace inflation and long-term capital appreciation. The other contributor, the other portion in this bucket is the defensive sleeve. Its mandate is to do no harm, mainly invest through fixed income and alternatives like gold, which has been a recent strong performer. The second bucket is tactical. It's a much smaller portion of every model portfolio. It's limited to 15% of equity risk, typically identifying investment opportunities in the 1 to 3 year timeline. It's measured against a balanced benchmark. Opportunities here are specific, they're targeted, they're timely, themes within appropriate risk measures, both within the stock and the bond market. Most recent example of an addition here was an energy fund that we added as oil prices plummeted. Global stock market and the S&P 500 are represented about 3% in the energy sector. We knew as an investment committee that we wanted to be over allocated to an investment opportunity as global economy recovered in the next 1 to 3 years. We considered exposure to MLPs. We looked at buying the commodity. We ultimately settled on exposure through energy stocks. Another manager highlight, another recent add to the client portfolio is through Brown International Small Cap, concentrated portfolio. Portfolio management team here is looking for a bottom-up approach to quality management teams with competitive advantages, the ability to continue to grow. It's benchmark agnostic. Management team has a very strong track record in navigating both economic expansions as well as market drawdowns. Eddie Brown, the founder, is actually one of the first minority portfolio managers who started his career in the late 70s at T. Rowe Price. Over the next 1 to 12 months, we're looking to identify the opportunities to make 10 to 12 good buys. We are definitely not trying to time the market and make 1 to 2 amazing buys. As Jim mentioned, the road ahead is filled with uncertainty. Our outlook remains cautious. That tone should be noted. We have no crystal ball, no one does. What will the future hold? Will the economy rise to reflect the current valuations and the optimism reflected in the current stock market prices? Or will the stock market experience volatility and potential drawdowns to meet the current economic conditions? We anticipate volatility and will continue to look for buying opportunities. We want to remind clients to make decisions through the lens of a financial plan with the guidance of your financial advisor. Every market creates planning opportunities. Before year end, here are several ideas that investors can consider with the help of their advisor. Worth reviewing any low cost basis investments. No matter who wins the election in November, we feel that the tax rates will be going up. This is an opportunity to plan ahead. And as you see market volatility, consider getting a step up in any cost basis as you would sell in an effort to manage future tax bills. It's also worth looking at any highly appreciated investments. This is an opportunity to maintain a diversified portfolio. And one opportunity that many clients have already taken advantage of is gifting appreciated stock or investments to a donor advised fund or charity or just rebalancing. It's worth reviewing sources of your cash reserve as well as income for the next 1 to 2 years. You don't want to make emotional decisions in times of market volatility. If you can have your cash reserves and your income sources identified through a financial plan, that leaves your investment portfolio, your risk assets, to benefit from a long-term investment horizon. We do anticipate another year-end rush from families to complete Roth conversions. These can be appropriate for retirees, for young investors, for professionals of all ages that anticipate any form of rising taxes over their, not just their career, but their life expectancy. Ultimately, the takeaway today is a couple themes. Please hear from us that uncertainty remains. This is not a time for speculation or unnecessary risk or adding risk. This is a time to be patient. This is a time to communicate. And this is ultimately a time to plan. On behalf of the entire investment committee, I'd like to thank everyone for your continued trust. I'll hand it back to Matt.
Thanks, Josh. And thanks, Jim, again, for everything that both of you shared. And thanks, everybody, for being here. As with any communication like this, we'd obviously prefer to be with you in person. But maybe this will serve as an opportunity for us to connect. As you have opportunity, please be in touch. We will pass a copy of this recording in your direction so that you can review all that we've shared. We're grateful for the opportunity to serve you and your family in this important way. Have a terrific evening, everyone. Good night.